All right, guys. Good evening once again, and welcome again to the second day of this bootcamp training. Right, as you can see on my screen here, all this we call it a chart. Okay, simply a chart of a currency pair, the US dollars. You can see here, right on my left. Okay, it's the US dollar. This actually it portrays, or it gives us information of how the economy of the US is faring. Okay, how strong or how weak the economy is. And if you see the chart going down like this, it actually means the economy is not, it wasn't doing well at that particular moment. And if you see it going up like this, it actually means the economy is doing good. It's trying, all right? It's doing good. That's their currency is appreciating. Okay, when it's going up like this, we say it's appreciating. When it's going down, it's depreciating. And again, if it's going up and you want to buy, remember, as I said yesterday, you are going long. Okay, so what we are going to be discussing today is going to be on technical analysis. Okay, it's going to be on technical analysis. That's going to be like introduction to technical analysis. Let me just type that here. So we have introduction, technical analysis. So we have introduction to technical analysis. This is going to be our main topic for today, introduction to technical analysis. And with this introduction to technical analysis, we're going to be like just looking at what you are actually seeing now on the screen, how to interpret things, or when you look at the chart, when you see something, how do you interpret it? Okay, the first things that we're going to talk about is going to be what we call candlesticks. Okay, it's going to be what we call candlesticks. Okay, which is actually what you are seeing now on the screen. Okay, like this is called a candlestick. Okay, this is actually called a candlestick. This is a candlestick. This is a candlestick. This is a candlestick. This is a candlestick. Now like I said, this is a chart, but actually what we have here is are candlesticks. You can see the red and the green candlesticks. Okay, now the red one, they signify a selling. They signify selling pressure, or they signifies a bearish move. A bearish move, a selling pressure, it's the same thing, or it's depreciating. Okay, so when you see red, it actually signifies that there's some the economy is not doing well at that particular moment. That's why the currency it's actually depreciating. Now, any candle that you see which is actually a red candle shows that it was a selling pressure in that particular candle. Like people were selling, all right? People were selling. And anytime you see a green candle, it means that people were buying, all right? So selling pressure comes into form selling red candles, and then buy pressure comes into form bullish candles. So we are going to be looking deeply to these candlesticks to see the theory behind it. Okay, because these candlesticks, as you see here, they are giving us a story. All right, it's a story that they are telling us. So when we look at this particular when we look at these candlesticks, we can be able to tell how the economy of a country is doing. Okay, remember I said that it just gives us a story. We look at this and then we tell the story. It portrays what is going on a particular country. Like for example, as I said here, this is the US dollar index, this is the chart for the US dollar, or this is how the US dollar is, okay, in terms of their economy, currency strength, and all those stuff. This is how their strength is. This is how they are. Okay, this is how the pair or the currency is. Okay, right now the current exchange for the dollar index is about 103.24245. That's the exchange rate for the moment. Okay, so when you look at this chart, it simply gives you an idea of what is going on with the USA. Now, yesterday I mentioned something that if let's say the date of there's a sudden a sudden news that the president is dead. Now, if that should happen immediately where we have here, if we should just receive this particular bad news that the president is dead, you are going to see a sudden drop of this currency pair down. Okay, it's going to drop massively down, massively. Why is it so? It's because it's a bad news. Many people will come in to sell at this point. Okay, they'll be selling, and as they're selling, they're going to be actually making profits. Okay, so what I'm trying to make you understand is if prices are going up, it means people are buying, and if it is coming down, it means people are selling. So now for you to know when prices will go up, because you are going to buy before prices go up so that you can make money. It's not when prices buy before you buy and you make money. No, you buy and as prices going up, that's how you make money. Okay, when prices goes up to a certain level and it starts to sell, and then you sell as well, that's when you are going to make money. You don't sell when prices have already dropped and you expect to make money. No, it doesn't work like that. It doesn't work like that. So what you see on my screen here is simply a chart, and there are so many chart types, but this is the most used and the most easy to understand chart. Okay, we're going to go over them. If you come here, okay, now my bad, I was supposed to let you guys know this particular platform. This is called TradingView. Okay, it's called TradingView. It simply portrays just an advanced features on what you have on your MetaTrader 4 and your MetaTrader 5. Okay, if you should go to your MetaTrader 4 or MetaTrader 5 and you search for the dollar index, you are going to see this same chart. You're going to see this same chart on your phone. Okay, but now with this dollar index, it actually gives us an advanced features like just what I wrote here using the text command. Okay, using the text command, you cannot write this on your MetaTrader 4 or MetaTrader 5 on your phone. So you will need TradingView to have these advanced features. Okay, and then to draw lines, draw so many stuffs on the chart that we're going to go into, which we use them for technical analysis to help us with our technical analysis. These advanced features can be seen only on this platform on TradingView. Okay, you cannot easily see them on your MetaTrader 4 or on your MetaTrader 4. You just have lines. Okay, there's no way for you to write text or annotate your charts in some certain ways. Okay, so now we have so many types of charts. If you click here, you're going to see all the type of charts that we have from here. The first one is called the bars. We have the candlesticks, we have the Heikin Hashi, and we have hollow candles. We have the line chart, we have line with markers, step line, area, and so on. Like for example, if you go to the area, this is how the area looks like, right? This is how the area can see. Now if you look at this one, it's kind of confusing. You will not actually know how to read the information on it. If you go to the line chart, you basically still the same thing. You will not actually know how to read the information on it. Now this is something here. Now look at where this is sitting. Okay, this arrow here from this line. Now this line chart did not come up to this point. Okay, but it closed just so it turned from here and then went down. But now if we should go to a candlestick, you will notice that price actually pushed up to this level before it dropped. So you will see that with the line chart, you actually have some you have some limitations to reading price. Okay, now you see price actually went up, went up to this place before it dropped. But when you look at it from the line chart, you are not basically going to see anything. All right, so we have so many types of charts, just so many, but the ones that are going to be the most that we'll be using, I mean the one that we are going to use is going to be just candlesticks. Okay, it's easy to understand, it's easy to see what is going on. Okay, it's just with a simple explanations like based on supply and demand. If the demand for the US dollar is very high, okay, it's very high, then prices will go up. If the supply for it is very high, then its price is going to go down. I'll just illustrate that to you. It's very, very easy. Now let's say you go to the market and you want to buy you go to the market Okay, you go to the market and you're selling oranges. Now, if one orange is equal to 100 francs, okay, or yeah, 100 francs with okay. If one orange is equal to 100 francs, and now you go to the market, let's say the demand for these oranges is very high, which means that you go to the market, let's say you go with 500 oranges, and then people came to buy these oranges like 1,000. Okay, you have like 1,000 people who are willing to buy, but only 500 oranges. What this means is that the demand for the oranges is actually high. Okay, now the demand for these oranges is high. Take note, is high. It's higher than the supply. This is the supply. The supply is just 500. This is what is available. But the people that are in demand of these things, they are more than the supply. So what will happen now is that the price of this orange is going to increase. If you are the seller, you should increase the price. That's how business is done, right? You will now notice that the price of one orange might now cost like 300 francs, right? That's how business is. If you go to any market and you notice that people are running to buy something, you see the prices increase. It's the same thing during the Christmas season, where you notice that people are rushing in to buy Christmas clothes and so on. The prices of the things increase. Okay, it's the same thing here when you are looking at the chart or when you are looking at the currency. When the demand for a currency is high, all right, the prices will increase. When the demand is high, the prices increase. Now, looking at it in the other way, opposite, let's say we have 500 oranges, all right, we have 500 oranges, and the people who are willing to buy, we have just 100 people. We have just 100 people that are willing to buy these 500 oranges. Now, at this point, the supply is greater than the demand. All right, the supply now is greater than the demand. That means you have 500 oranges and only 100 people want to buy. Now, if one orange here costs 100 francs, at this point, since the demand, since the supply is more than the demand, okay, the people who want it is very small, but meanwhile the supply is very high. At this point, you will notice that you have a small demand, but you have a big the demand is the supply is actually much, or the supply is greater than the demand. What happens at this stage now is that at this point you have to reduce the prices. If not, you carry back your oranges back home. You understand? So it is the same thing here on the charts. When the supply for an asset, when the supply for an asset is higher than the demand, okay, what that means is that the prices will have to drop, and then that means you're going to see a chart going down, right? And now when it goes down to a certain level and the demand comes in to be very high, now prices will go back up. Let me give another example again so that you understand. Now let's say this is it at this point. Okay, let's explain it right here. Now when prices drop down to this particular level here, okay, what made prices to go up here was that the demand for this price was very high. Okay, the demand for this asset, the US dollar, was very high. And what happened? The prices had to increase. The prices had to increase. It's normal. That's how business functions. Okay, if you go to the market with something you want to sell, and you notice that a lot of people are flocking in to buy, you must increase the price. As a good business person, you should increase the price. That's how business is done. If you don't, you are not going to make any tangible profits, right? That's how business is done. Okay. So now what happened here is when prices drop down to this level, what happened? The demand was high. The demand was high and prices had to rally up. Prices had to rally up, and then now when it went up right up to this point, what happened before it started selling? I'm giving this illustration for you so that you get to understand why prices should be going up, why prices just go up and then they start coming back down. Now it went up to this point and the supply, now it was the demand that had to push prices up to this point. Now if you notice, you will notice that the demand here came in at a lower price, right? You did not see it's not here that you will notice the demand of something. When people are coming in to buy something, naturally it's because it is at a low price. It is at a low price, okay? Which means if you go to the market, let's say you go to the supermarket and you notice that, okay, a chicken that was sold for 10,000 francs is now 5,000 francs. As a reasonable person, you know that, okay, maybe tomorrow this chicken price will go back to 10,000, right? Now, as somebody that's reasonable, you now take 10,000 and you buy like 2, right? You buy more to save some money for tomorrow, right? Now, at this point, when the price of it drops, that's when investors, they come in, right? They come in to buy at a lower price. And now, when they buy at a lower price, as prices going up, they are making money, okay? And then when they are making money, if it now goes up to a certain level, where they see now that, oh, prices of this is actually very high now, we should now be selling. Now, in a business, I always love to give these examples, okay? Now, now at this point, a lot of businessmen, they are stocking up goods to sell during the Christmas season, right? Why? Because at that time, the prices of things will be very high. It's the same thing here, okay? When the prices of this is at this point is high, that's when people will start selling. So what this means is that you are going to be buying at a lower rate, you're going to be buying low, and you are going to be selling high. This is the first rule of trading. Okay, that's the first rule of trading that I just gave you right now. The first rule of trading. Okay, so what's rule number 1? Rule number 1 says that you buy low and you sell high. Okay, that's rule number 1. Buy low and sell high. If you don't do this, you are not going to ever make any money in Forex. Okay, if you don't buy low and sell high, you will never make any money in Forex. Even in any business, you cannot go to import things from China. You go and import at a higher price to come back and sell at a lower price. It will not work. So you must buy something at a lower price and you sell it at a higher price. So what this means on my chart here is that you should be able to buy at a lower price. You should be able to buy low and you should be able to sell high. Okay, you should be able to buy low and you sell high, buy low and you sell high. Now at this point, what you will need to know is when is an asset at a higher place for me to sell, when is an asset at a lower place for me to buy. That's what we'll be driving into in our coming classes, okay? But for today, I just want you to understand that when you look at the chart like this and you see prices going up and coming down, it's actually due to the buying and the selling pressure and so on, okay? I just want you to have that mindset that when prices are going up, it's actually due to buy orders that are coming in to the market. Is actually due to the demand of the asset that is pushing it. If you have this mindset, it will be very easy for you to understand as we go forward, all right, to deeper things into this. Now you know that when prices are dropping, actually means that you should be selling, right? Sell high and you buy low. So we're now going to go deeper now to understanding these candlesticks. Okay, that's going to be the main thing for this particular session, understanding the candlesticks. If you look on my left here, these are currency pairs. So we're going to have a class that will just explain how to use this TradingView. Okay, because it's going to quite be difficult for some of you, and I'm going to make a lesson on how to use the TradingView. Okay, but for now we are going to talk on candlesticks, how to interpret candlesticks, and what you see right up here, which is you have the 1 minute, 3 minute, 5 minute, 15 minute, 30 minute, 45, 1 hour, 2 hours, and so on. We call these are time frames. Okay, these are time frames. Now we have these candlesticks are formed based on time. They are formed based on timing. Okay, they are formed based on timing. Now each candlesticks now that you see on my chart, as you can see here, it has been highlighted that this is D, which is 1 day. Each candlestick that you see on my chart here takes 24 hours to close, to open and then to close, then another one opens. Okay, each candlestick here takes 24 hours to open and then close. All right, so now you can see that we are currently trading. This is the current candle that has formed today. All right, this is the current candle that has formed today and it's still trading around 303. Now you can notice that it has like 3 hours 02 minutes to close. Okay, now this is the only candle that has formed today. Remember I said we are on a daily time frame, and I said candlesticks, they form based on time. They form based on time. So this is today's candle, which is Tuesday. But now this is Monday's candle. This is Friday's candle. Remember we said Forex, it's open 5 days a week. So we have Tuesday's candle, which is today. We have Monday, we have Friday, we have Thursday, and so on. But now if one candle here has 24 hours to close, to open and close. Now what if we go to the weekly chart? Okay, if we should click the weekly chart, you will notice that each candle here takes a whole week to form, which is 5 days. Okay, so which means that a single candle like this takes 5 days to form, which is 5 candlesticks. All right, which is 5 candlesticks. So this is the current weekly candle that is still on now. It's still open. It is not closed yet. Like this one is closed already, this one is closed, and so on. It's this one here is going to be closed on Friday. So like I said, candles are formed based on timing. They are formed based on timing. Okay, they are formed based on timing, and these are the timings here. We have 1 minute right up to the 1 year chart. Okay, now let's look at the 12 months. This is a 12-month chart here. Now this particular candle here, okay, this particular candle here is the candle that started this year on January. This particular candle here, this is a candle that started this year on January. This one is the candle of 2022. Okay, that's the 2022 candle. This one, this candle is 2021, 2020, 2019, 2018, 2017, and so on and so forth. Or at this point, with the week yearly chart, a candlestick takes 1 year to form. Okay, which means that this candle will close on December, and then another one will open January, 1st January, and it will trade till 2024 ends, and it closes again. So this is 2023 candle that is forming, right? That's still on now. Now, if you go to the monthly chart, this is the monthly chart. A candle here takes a month to open and to close. We are going to study how it opens and how it closes and all these things that you see here. Okay. Now, this is the current candle of this August. Okay, you can see that it's actually a bullish candle. It is pushing up, right? Unlike the candle of July, which was a bearish candle, was red, and that of June. June was red, which is a bearish candle. July was red as well, which is also a bearish candle, and August now is currently a bullish candle, green candle, right? So current August is still open. This is still the 15th. All right, exactly on the 30th of August, this candle is going to close and a new candle will open for September. All right, so let me remind you again, everything candlesticks that you see here, they are formed based on timing. They are formed based on timing. Okay, based on timing. Now let's go to the weekly chart. Like I said, with the weekly candle, it takes 5 days to form a weekly candle. It takes 5 days to form a weekly candle. It takes 4 weeks to form a monthly candle. It takes 12 months to form a monthly candle. And now we go down to 4-hour chart. This is the 4-hour chart. Okay, this is our 4-hour chart. Now with this 4-hour chart, it takes 4 hours for a candle to open and close. It takes 4 hours for a candle to open and close. And now if you go to 1 hour, it takes 60 minutes for a 1-hour candle to open and close. 60 minutes for a candle to open and close. Now you could see that this is exactly 9:01, and then this candle just opened. Okay, this is a candle that just opened right now, and and then this is the candle of 8 o'clock. This was the candle of 8. All right, and then this now is a candle of 9 o'clock. All right, it just opened. All right, now we go down to 15 minutes. This is a 15-minute chart, and this candle takes here 15 minutes. All right, to open and close. All right, so you have the 1 minute chart. The 1 minute chart here, a candle takes 1 minute to open and close. It takes 1 minute to open and close. So if we're just looking at this candle here, okay, this current candle, and we have 2:09. All right, exactly at 3:09, we're going to see a new candle that is going to form at this point. Okay, we are going to see a new candle that is going to open, and then this current candle is going to close. Okay, so every candle that you see on the chart is formed based on timing. It's formed based on timing. Okay, so we have like 14 seconds for a new candle to open, for this one to close, and a new candle to open. Okay, we have 6 seconds, we have 4 seconds, 3 seconds, 2 seconds, 1 second, and boom. All right, a new candle should form. Now this candle has closed and a new candle has formed. That's how it is done. This is now the 1 minute chart. That's why it was very easy, fast for the candle to open and close. Okay, so now what we are going to do is we are going to study how, I mean, you have seen the candle going up and coming down. We're going to study why that is happening, and how to understand if that why that has happened, right? So we're going to do that with this daily candle. Let's use the daily chart. This is the current candle. This is the Tuesday, 15th of August. This is the current candle that is still trading right now. Now you will see this white line here. It is called a wick. Okay, we call it a wick. Let's make it a bit small. All right, this is called a wick. That's a wick. Okay, what you see like this is a wick, this is a wick, this is a wick, and so on. There's so many wicks. Almost every candle has a wick. Okay, almost every candle has a wick. You can see this is a wick, this is a wick. It might be small, but it's a wick, it's a wick, it's a wick. Every candle has a wick. Okay, we call it wicks. All right, every candle has a wick, every candle has a wick, every candle has a wick. Okay, now this is a wick, and now what does this wick represent? Okay, what does this wick represent? Like I said, we're going to be studying the candlestick anatomy. All right, we're going to be digging deep inside this candlestick. Now this is a wick. Now this price traded, this all candle opened and then went down to this point. Now when it came down to this point, where was the opening price? Now this is where the opening price was. This is where the candle opened from here. Okay, that's where the candle opened, because this is where it's currently trading now. It's currently trading at this point. Or let's do this. I'm going to hide this candlestick so that we work on a candlestick that has opened and closed already. Okay, we're going to work on a candlestick that has opened and closed already. Let me hide this one. Okay, so I've hidden that current candle. So we are going to work on this particular one. So we have this as our wick. Okay, those are wicks. Let me even put it on this one. That's a trading, that's a wick. Now this is actually a bullish candle. Okay, that's a bullish candle. A bullish candle. Okay, this is a bullish candle. A bullish candle. Now let's study how a bullish candle opens and then it closes and so on. For a bullish candle, okay, for a bullish candle, now for a bullish candle, remember I said for a bullish candle, so for a candle to be considered bullish, it it has to be green, all right, which means it opens down and it closes above the opening price. It opens down and it closes above the opening price. So for a bullish candle, this is the opening price of the bullish candle. Let me write that. Open. That's the open. Okay. This is the opening price for this particular candle. Let me make it a little bit big. Okay. This is the opening price of this bullish candle. Remember, we are looking at a bullish candle. Okay, and for a bullish candle, this is where the opening price is. Now, when it opens here, it actually traded down to this point. And when it traded down to this point, this was the last price point that it traded down to before it started going back up. So, how do we call this? It is called a low, right? That's the candle's low. This point here is the low of this particular candle. Now, it went right up to this point. It actually went right up to this point before it came back down and closed at this price point. So what happened is, this is now going to be the high of this candle. That's going to be the high of this candle, and then at this point, this was where the candle closed. Okay, the close of a candle is very, very important, because it's the close that determines whether it's a bullish candle or a bearish candle. Okay, so we have the high of the candle, we have the close of the candle here, we have the open of the candle, and we have the low of the candle. And what you see here is the body of the candle. Okay, this is the body of the candle. That's the body of the candle. Okay. So this is actually the body of this candle. This is the wicks. This is the wicks. We have the high, we have the close, we have the opening price, we have the low of the candle. Okay. So this means that price opens here, traded down, created a low. All right. It traded down and reached at this point. Buyers came in. All right. Buying pressure, buy orders came in and pushed back price up to this point. When it pushed price up to this point, what happened? Sellers came into the market. And when sellers came to the market, they pushed back price down to this point, and the market closed at this point. Okay, and then before now the new candle opened. All right, before the new candle opened. Now this is for a bullish candle. This is actually for a bullish candle. Now let's study it for a bearish candle. Let's study how a bearish candle is. Okay, I'm going to hide all this so that we'll study this. Okay. Now this is actually a bearish candle right in front of me here. Okay, so now with this bearish candle here, let me write down. Okay, we have a bearish candle. You can call it a bearish candlestick. Okay, bearish candlestick. This is a bearish candlestick. This one, the red candle, it's a bearish candlestick. Why is it a bearish candle? Because it opens high and it closes lower. Okay, it opens at high and then it closes lower. So if this is the case, the low of the candle remains the same. Okay, the low of something should always be down. The low of the candle remains the same. The high of the candle remains the same. It remains the same. The high of the candle remains the same. It's where the candle traded up to the highest point, where the highest price point, where the candle traded up to before it sell off, and then the lowest point where the candle sold down to before going back up. Now this should not get you so much confused. All right, I just want you to know that, okay, if you look at a candle like this, all right, you say, okay, this candle traded up to this point before it came back down. It's not actually like you need to cram some stuffs and so on. I'm just giving you how to interpret a candle once you see it. Okay, how to interpret and how to differentiate between a bullish and a bearish candle. Now the opening price here is now what will change. Okay, because this now, a bearish candle now opens high. Okay, it opens high at this point. This is where the opening price is, and then it closes lower. Okay, it closes lower, unlike a bullish candle, and then this is still the body of the candle. So this is unlike a bullish candle that opens high, that opens at low and then closes high. Okay, but now for a bearish candle, it opens high and then it closes lower, but the highs, they remain the same. They remain the same. They remain the same. They don't change. Okay, they don't change. So we have so many types of candlesticks. We have so many types of candlesticks. I'm going to send you something that will make you, something that you easily visualize the types of candlesticks that we have here. Like you can see here, we have this huge candle. You have this huge candle. You see some ones like this one, which actually looks like a cross. Okay, it's called a Doji. All right, this candlestick is called a Doji. A candlestick that barely have a body. Okay, a candlestick that barely have a body is called a Doji, which means that this particular candle, this is actually a bullish Doji. If it is a bullish Doji, it means that it actually opened well. If it is a bullish Doji, it means that it opened down, okay, and it closed up just slightly above where it opened. Okay, just slightly above where it opened, that's when it closed. And now the low remains the same down, and then the high remains the same up. Okay, it's the same things across board, the same things everywhere. It's a bullish Doji. It opens down and it closes slightly above the opening price. So now if this is a bearish candle and I ask you what is the opening price, you should be trying to get a figure from here, and let's draw a line from there. The opening price of this candle, you can see it here, which is 102.454. okay, that's the opening price. And where did it close? You should now bring the line down. Okay, or if you have a cursor here, you can use your cursor and then you point it here, and you will notice that it is at 102.000. That's where you have the close of the candle. Now if I ask you where was the high of the candle, it should be somewhere here, trying to find out, which is 102.625, and then the low of the candle comes in at 101.743. okay, so that's how you read candles. Every candle here is the same. Everything that I've explained here based on the opening, high, low and close of the candle, it is the same across all time frames. Okay, it's the same across all time frames. If you go to the monthly, to the 12 months, which is the yearly candle, which is the yearly chart, if you go to the yearly chart, you will notice that each candle has the same high, it has a low, and it has the opening price and so on. Like for example, this let's look at this one. This is I want us to look at let's look at the candlestick that forms very far this here, like this one from here. Okay, now this is actually, wow, which date is this? 2003. Okay, this candle formed since 2003, and it was actually a bearish candle. What does that mean? This means that price opened. This means that price opened at this point. Okay, this was the opening price for this particular candle. It opens, went up, created a high. Okay, that was the high of the candle. Traded down, right down to this point, which was the low of the candle. All right, and now if that's the low of the candle, let's zoom in a little bit so that you see where the close of the candle is. Now this is where the close of the candle is. And now if this candle closes at this point, what should happen is the next candle should open around somewhere there. Okay, if the close of this bearish candle should be here, then the next candle should open at the same price where the other candle has closed, right? Let's try to play that out and we'll see something. Okay, now you have noticed that this candle has opened just where the old candle closed, right? Now let's try to play this. Okay, the candle is still on, it's still on, it's still on, and it's still on. You see how it's trying to trade, right? So let's see if this candle is going to close bearish or bullish. Now you'll notice that this candle has created a low, okay, but it has not closed yet, which means you can see might still come down to clear it again. Okay, now it is creating a high, all right, but it has not closed yet, so we will not know at the highest point this candle might form before it closes. Okay, so this is actually how a candle forms. And now our reason for doing technical analysis will be to see how to know when a candle is going to be a buy or when it's going to be bullish, and then to know when we can be selling. All right, like for example, if we're looking at this one here, why we're doing analysis is to know if we are going to be selling or we are going to be buying this particular candle at this particular time. All right, so that is the reason for technical analysis. So you can now see that this candle has formed a high here, and then it has closed a bearish candle. Okay, it went up to this point. Now, why did it reverse exactly at this point? That's what we're going to find out when we go deeper into technical analysis. Why did it reverse here before going down? And this should be where we'll start selling. Now, this is a yearly candle. Okay, this is a yearly candle. And remember I said this alone yearly candle takes 12 candles of the monthly chart to form. Okay, 12 candles of the monthly chart to form a 1 year candle. Let's go to the monthly chart and then we'll see. Now, this is where it is. We need 12 candles here, which is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. All right, this is 12. This is 12. So which means all from here, this is where we had. This is the 12 months trading. Okay, it first of all opened during January, February, March, April, May, and then May created the high of the candle, and then we have June, July, August, September, October, November until December created the low of that yearly candle. So that's simply how this candle forms. Okay, inside the 1 year candle alone, we have seen so many monthly candles, and it's still the same process. Each candle, like for example, if we're zooming into this December candle, we'll still notice that it opened as this is actually a bearish candle. So we'll still notice that it opened here, created a high, all right, created a low, and then it closed at this point. Same thing with this one. It opens here, created a high, created a low, closed at that point, and then it created a low right here. Now when it closed, this one opened at the same place. Now this one opened, all right, came down, created a low, closed, and then this one opened. So that's simply how it is. And these things, this is how it is all across all time frames. It is like this in all time frames. Okay, so that's simply just an introduction to candlesticks, how candlesticks form and so on. Okay, how candlesticks forms and so on. All right, so we're going to, I don't want this to be long because I just want us to have an introduction to seeing candlesticks, how they form, and then now in our next lesson we'll start going out to how to know if we are at a low position to buy an asset, or how to know if we are in a high position to sell an asset. Remember I said the first rule is you buy low and you sell high. Okay, that's your first golden rule as a trader. You buy at a lower price and you sell at a higher price. And how do you determine if prices is low or if prices is high? That's the reason why we're going to be doing technical analysis. Okay, so guys, that's it. I don't know if you have questions. If you have questions, you ask. I didn't want this to be very long. Okay, so if you have questions, let me have it. You can now unmute yourself. Allow participants to unmute yourself. Okay, if you have questions, If you have a question, you can unmute yourself and then you ask. If only your background is not noisy, please.
Hello?
Please, your background is so noisy. You can write it on the text box. If you have a question and your background is not noisy, you can ask the question, please. Okay. You can unmute yourself and you ask the question.
Please, I wish to know the difference between the bullish, between the different candlesticks, because we're talking about the bullish and somehow I got confused about the two of the candlesticks.
I said the bearish candlestick here is the red one. Okay, the bearish candlestick means its price is going down. A bullish candlestick means price is going up. Right? This is the green one here is a bullish candle. The red one is a bearish candle, which means price is selling. Like you can see here, any bullish candle you see series of bullish candles. You see green candles, series of bearish candles, you see red. They're actually dropping. So when price is high for you to sell, if you sell, you should be expecting lower prices. Okay, you should be expecting lower prices, which means you should be expecting red candles to be forming, right? I don't know if that answers your question. Red candles are bearish candles. Green here are red candles. You can actually change the color to whatever color you like. Let me do that, and then you see color thing. Let's take light. Okay, you can actually change the color to any of your choice, like this one we have now, right? You now notice here that bearish candles here are black and bullish candles are white, right? Can you see that? So bullish candles here are white and bearish candles are red, are black candles, right? So that's how it is. You can decide on any color that you want to use. So it's not actually based on the coloring. It's just for you to be able to identify if a candle is bullish or bearish. Okay. Because why this is important is because as we move on, we're going to use bullish candles and bearish candles for some purposes, right? Which will help us a lot. That's why you have to differentiate bullish and bearish candles. So please, why does some candles close and the next candle is slightly not aligned to the previous candle? This is Yanko. This man is terrible. I wasn't expecting anyone to actually see that. You are very, very smart and vigilant. That's interesting. So it's asking, let me try to zoom out so that you see. Let me go back to the dollar here. We're going to see that here. You actually saw it now. This is an example here. Let me zoom in so that we see clearly. Okay, now this is your question. Why? This is actually a bullish candle, right? The white candles are bullish. Okay, white candles are bullish, and then bearish candles are black. So a bullish candle closes up, right? So this one was supposed to open at this point, but it came up to open at this level. Okay, so we're having the opening of this one here. That's where we have the open, and here we have the close of this one. So we're having a slight difference between the two. Now we call this a volume gap. Okay, we call this a volume gap. The difference between the close of this candle and the opening of this one, we call it a volume gap. Right? It's called a volume gap, and the reason for that is because of the open positions. the volume of the positions, right? Which means that let's say this candle open and it closes at this point, right? That's all. Volume gap. Okay, let's say this candle opened, it closes at this point, and then this one skipped to open. Now this happens due to large orders coming into the market. Okay, it comes in due to large orders coming into the market. It's like when you go to the market and you see these people that are selling things at option price, right? You're like, okay, they say maybe they take something off, and you're like, okay, people are giving prices. You're like, okay, let's say they start from 10,000, and then the next person say 11,000. That is actually chronological, right? The other person say 12,000, 13,000, 14,000. Now, if somebody suddenly comes in and just say 200,000, this is the explanation to it. Okay, orders came in. That is, there was a volume of orders that came in that actually made price to skip. Okay, now that's just the simple explanation I will give you. But as we move on, we're going to study how to trade these particular scenarios. I guess that answers your question, right? It is due to volume of orders. Okay, high volume of orders that comes into the marketplace. That was actually interesting. I didn't expect someone to to notice that. Let me get back to okay.